The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organization mentioned in this podcast.
Okay, Thursday the 29th of August. Welcome back, Jeremy. Good to have you here again.
Hi, Gareth. Good to be here.
Interesting week, short week here in the UK. Interested to know what you've been thinking. Obviously, you had a bit longer to think about Jay Powell and the Jackson Hole stuff from last week. Any, I guess, further thoughts on that and anything else catching your eye more broadly?
Yeah, it's been, I think a lot of people away. It's been quite a quiet week in terms of stuff out, certainly from the UK. But as you say, financial markets have really had a bit of time to sort of come to terms with the implications of Jackson Hole and Jay Powell's speech from Friday. And I mean, the headline is that the time has come, and the time has come to lower interest rates. And they're signaling very strongly that they feel that the battle against inflation is less important now than the battle against unemployment. Unlike the Bank of England, the Fed has a dual mandate to look after the value of the dollar and also to maintain order in the labour market. And Fed officials, they've just clearly indicated now that they're more focused on the labour side of things. And in the words of Jay Powell, he said that central bankers don't seek or welcome further cooling in labour market conditions. So This is in response to some unemployment figures that spiked higher back in July. We can go back that far, this is ahead of the sort of early August market volatility when the Son rule on US unemployment became a thing that seemed to be driving fears in the market. So that's where we are.
Okay, so US rates almost definitely headed in a downward direction, which is obviously good. And how have markets taken that as they've digested the news and they've reacted?
I think broadly speaking, markets, certainly the equity market, is saying, thanks, Jay, but we're already there. And the dollar's weakened a bit more, but that's been a 6-8 week downward trajectory. It's picked up a bit in the last 24 hours or so, but it's heading to 100. It's sort of over the last couple of months now, it's 5-6% weaker, which is good news for everybody else. It improves financial conditions for the rest of us. So FX markets are sort of saying US rates are coming down, the dollar's going down with it. And so relatively speaking, both the pound and I think significantly the yen have both strengthened this week. Precious metals have strengthened. And as I said, bond markets and equity markets have been pretty stable, really. I mean, they're up a bit, down a bit, but no real reaction.
Okay.
But within the equity market complex, particularly smaller companies, less liquid companies have done better than larger companies. So I think that's a continuing and I would argue quite an encouraging trend. Basically, I think markets have said, nice to hear it, Jay. Well done. Now just deliver on it, because if you look at bond markets, they're saying there's going to be 7 or 8 rate cuts, quarter point rate cuts between now and 9-12 months' time. And that is a pretty steep downward trajectory of interest rates that you would normally associate with pretty weak economic conditions. So I think that's quite a bold statement coming out of the bond market.
Yeah. And what are the economic conditions? Have we heard anything further in the last few days that feed into that?
Yeah. I mean, today we've had confirmation that the US economy is actually doing better than people feared. So we're having to wrestle with conflicting data, and 1 month's data isn't necessarily a trend, particularly in things like quarterly measures of GDP. But they've had a second guess at what the Q2 GDP was for the US economy today, in fact. And they said
it shouldn't really be guesswork, should it? But no,
it wasn't 2.8%, but it was actually 3%, which is a very good figure. So I don't think people are really quite sure what to make of that. But arguably, it's great news, isn't it? You're getting a growing economy and you'll get lower rates. So that should be good for equities. But it's never usually quite that simple.
No, but if the US economy can be growing at 3% a year, even with give or take 5% interest rates, then it does show that they're doing something right.
Yeah, it does. Absolutely. That is maybe an indicator that the soft landing is now in and we can all relax. But I'd say it's still a little bit early.
Okay. There was one company that definitely didn't have a soft landing. I don't know if it's time to talk about Nvidia, but that's something that we should certainly touch on. And as you say, there hasn't been a huge amount of news in the UK this week, but certainly we've been looking across the pond at Nvidia in particular, and they delivered some absolutely knockout results, revenue ahead of expectations for the quarter they were reporting, profit all in line and looking very strong, and their guidance for the forward quarter was ahead of expectations. So it couldn't have been more perfect in terms of delivery, and the stock fell, I think, 6 or 7%.
Yeah, and I think this was the outlier. We had the other Mag 7 a couple of weeks ago, and it was sort of a bit of a mixed bag.
Yeah.
And broadly, the Mag 7 are bouncing around, but they're not making new highs. And Nvidia is the bellwether because they're the ones whose product all the others are queuing up to buy. And I think the message is that when prices go down, when markets go down on what is good or inline news, I mean, 100% revenue growth for the quarter year on year. I think they give or take. I think that was the number. But your share price goes down 7%. Well, that's not a good sign.
Yeah,
it tells you the market is over its skis.
Yeah, no, I think that's right. And I remember back when I used to cover US stocks, I learned a bit about the way that US analysts work, and it's a slightly strange setup they've got because a number of them have, or certainly used to have, their official forecasts, which were published numbers that they'd be quoting for the current quarter's earnings from whichever company. And then they would have what they used to call the whisper number, which was what they were telling their clients sort of quietly.
For the good clients.
Yeah, exactly. Well, that was the thing. I'm never quite sure how it was legal, but there was this thing called the whisper number, and you could have a company which is hitting the official consensus estimates, but if it's not quite as good as the whisper number is suggesting or is requiring, then you can get this disappointment in terms of performance, for poor performance on what look like consensus beating numbers. But I think it's probably a bit broader than that. I think it is more of a sentiment thing or a psychology thing. I think there's worry creeping into the markets, and potentially it is just investors saying, look, it's had a fantastic run. Obviously, it'll continue growing, but there is an element of risk creeping in or an element of caution creeping in that wasn't there 1 or 2 or 3 quarters ago. So I think there is a bit of a shift from what I've seen and from what you read.
I think they did talk a bit about product roadmaps being a little bit slower for next year.
Yeah, I mean, they've got a product called Blackwell, which is the next generation chip. And it's 4 times as powerful as the current one. So obviously everybody's queuing up to buy that one. And Blackwell is being delayed. There's a technical manufacturing issue, which I think it's with TSMC and the actual production of the chip. There's obviously a very advanced chip, and it's pushing the boundaries in terms of what can be achieved. And it does feel, to your point, they're a bit ahead over their skis in terms of where they've got to with that product. And the danger is that people might stop buying the existing product in anticipation of waiting not many weeks or maybe only a quarter or 2 for the new one, which is 4 times as powerful. And you probably want that one if you can manage to wait till it comes along. So there are challenges in terms of the business performance. And perhaps that's feeding into the psychology and the sentiment as well, although they as a company were very upbeat about the coming quarter in terms of revenue forecasts and the delivery they expect to make. So they're not suggesting it's really going to have any material impact. So it's interesting to see the way the markets have reacted, because it made me think a bit more about capital and the cost of capital. And obviously that's what really drives shareholder value in the long term is can a company deliver return on capital in excess of their cost of capital. That's what drives corporate performance and share price performance over the long term. And the tech sector has been quite lucky with the way that they've been treated in terms of capital, because they're a very investable sector. And arguably back in the dot-com boom, and perhaps for some of these Magnificent Seven recently, the cost of capital has been almost zero. They've had almost unlimited capital available very, very cheaply and at no notice that they're able to raise money whenever they want to. And it may be that that's coming to an end or slowing down, or that they're being held to account slightly more aggressively by their investors, which might be a good thing. It might mean that capital that has been freely available to them might be allocated more generally, whether that's globally to other markets or to smaller stocks. Either of those, I think, would be great for the UK market, because it's what we've got is really a collection of, in global terms, mid or small cap stocks or even micro cap stocks. And if capital's spreading out from the Mag 7 for whatever reason, as we've said in previous calls, I think
absolutely. Yeah, we don't need much of it.
No, correct.
I don't think we're at the stage where the likes of Amazon, Microsoft and Google or Meta are easing off their desire to buy the output from NVIDIA because they're not overtly constrained, because they've all got hundreds of billions of dollars sitting on their balance sheet, which they don't need shareholder approval to invest. I think it's all about understanding game theory than actually understanding a traditional return on capital metric, because they're all engaged in a battle where if they are trying to achieve artificial general intelligence, and this is the big debate, I think, as whether generative AI can and will lead to artificial general intelligence, then it's a winner-takes-all game. They're trying to build God, and therefore, if God cost $1 trillion, then I'm going to spend $1 trillion, because if I don't, somebody else will.
Yeah.
Therefore, if I come second, I've probably wasted the best part of $1 trillion in malinvestment. And I think the shareholders are beginning to wake up to the reality that actually there may be no version of God, but there may be only one version of God. Therefore, there's going to be a lot of wasted capital here, which was exactly the case for the internet, the build out of the internet in the late 90s.
And I think you're right. Maybe investors are now beginning to worry that not all of the buyers of NVIDIA's products are going to make a handsome return for their own shareholders. That might not be a problem for NVIDIA, but down the track, there will be companies being held to account, and maybe that day of reckoning is coming a bit closer.
You're absolutely right. I mean, we could be some way away from that point, but then it's going to be who are going to be the winners on the application layer for AI.
Yeah.
Who's going to be the AI 2.0 companies that everyone will want to be shareholders of in the early 2030s, probably.
Correct. It's the companies that will benefit from being able to use AI cleverly, or build it into their processes, or streamline their operations dramatically through the use of AI. And we've seen Klarna this week talking about some cost reductions. They've cut 15% of the staff. I think they're talking about cutting
maybe 20%. It's a big chunk. And we think of software companies or technology companies going in and trying to compete for their share of the IT budget for a corporate. Well, that's not going to be the case with AI.
No.
You're taking out the workforce. It's the labor budget.
It's genuinely transforming the business by reshaping it very, very aggressively.
Which is what, absolutely, which Klarna is saying that they're doing with their customer support, I think.
Okay, so just thinking a little bit more generally, lack of any material UK news to talk through, what do you think you're going to be looking at next week?
So next week, we've got US ISM manufacturing PMI data for August, which is still below 50. So I think we're going to get another number below 50. So there's another data point here for the US economy, which I think is going to be...
That's the purchasing managers, is that the one? Yeah.
Purchasing managers index. So this is a forward-looking survey, and anything below 50 is a negative, and it's been below 50 for a while. It's also jobs week next week. I think this is going to be the main talking point. So we get the JOLTS job opening data on Wednesday. That figure is now through 8 million. I think the number is going to be around 8.2 million. So if that's a big number, then I think that would be taken positively in the current environment. And on Friday, we've got the non-farm payrolls, which last month was 114,000. And we also got the unemployment rate for August. And last month, that was 4.3%. And if you remember last month, that's what set off some volatility around the SARM rule. And is the US heading into a recession? And if so, how severe is that recession?
That was what caused the worries about the US interest rates. And that then tipped into the issue to do with the carry trade and the yen, wasn't it? Okay. Well, let's hope we don't have that again next week.
The thing about the labour market data is that they are backward looking, they're lagged, and they've never been considered particularly reliable. And after the big revision last month of 800,000, they're even less reliable than they were. So it's anybody's guess what these numbers are. But we are at a critical point where we need data to really get a handle on what direction the US economy is in, because we're at this critical juncture for interest rates. So it's a bit of a mess, quite frankly.
Okay. Well, hopefully next week we'll shed a bit of light into that confusion and darkness. And look forward to catching up this time next week and see what's happened.
Okay, see you then.
Thanks.
Brought to you by Progressive Equity.